Welcome to the series of Those Damn Terms, in which we try to understand the meaning of a financial term in the simplest possible manner, that too in 5 minutes. Today's term of discussion is ROCE. ROCE stands for Return on Capital Employed and is expressed as a percentage. As always, instead of going into the definition first, let's start with an example. Let's take the case of company A. The owners of the company invested 10 rupees. More money is needed for the business to run. They open up the company for investing, which means people like you and me can put money in the company. Suppose the total invested by people like us is 110 rupees. Looks like some more money is needed for the business. The company takes a loan of 100 rupees. The money invested by the owners and people like us put together is called equity. There are other forms of equity called preferred equity also, which we are not discussing now. The promoters of the company and people like us who invest money in the company are all shareholders. The total amount invested by all of us is the equity. The loan amount is nothing but the debt or liability. Many other kinds of liabilities may exist for the company, like bonds, which we are not discussing here. So totally, how much money is invested in the company? 220 rupees, with which the company set up its business. After few months, the company makes sales of 500 rupees. The costs of raw materials, labor, etc. used to create the items or goods is 100 rupees. Other expenses like rent, sales and shipping, salaries, office charges, etc. come to 50 rupees. Let's subtract the costs and expenses from the sales amount. What are we left with? This 350 rupees is nothing but EBIT, that is earnings before interest and taxes, or operating profit. For a total of 220 rupees invested, the company generated operating profit of 350 rupees. Let's clear this workspace and look what we got. For 220 rupees of investment, the company generated 350 rupees. As a percentage, it is 159%. This is the return on capital employed, or ROCE. Look at the term liability here. Liabilities are of two types: current and long-term liabilities. Current liabilities are short-term obligations which need to be paid within 1 year, like accounts payable and short-term debt. Long-term liabilities are debt amounts which are long-term in nature, more than 1 year. While calculating ROE, the debt amount included in the denominator is only the long-term debt and not the short-term liabilities. ROCE, as the name suggests, is the return on capital employed. Return means EBIT, that is the earnings before interest and tax, and capital employed is nothing but total assets minus current liabilities. Simply put, ROCE tells us how efficiently the company is using its capital to generate profits. Another commonly asked question is the difference between ROE, return on equity, and ROCE, return on capital employed. ROE is calculated for the equity amount and ROCE is calculated for the capital employed, meaning equity amount and the long-term debts of the company. The return calculated for ROE is the net profit and for ROCE it is earnings before interest and taxes.